Hey everybody, Mike DeCepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, December 16th, 2022. We have a cold and rainy day here in New York, so hopefully wherever you're watching this video from, it's a little bit warmer and a little bit drier. We had a lot of news this week for the markets to digest. We'll go through some of those specific news events with you here today, show you what the market impact was. All in all, not a great week for the markets. Looking like the first losing week for the markets, unless some sort of a miracle happens over the next couple hours here. But it's going to be the first losing week for the markets in the last 5 weeks, right? All good things have to come to an end. Not every winning streak can last forever, but we don't think this is the end of this short-term rally that the market is in, just more of a pause, the pause that will refresh, if you will. So, like I said, we had a busy week. Started with the Consumer Price Index report on Tuesday morning. Much anticipated report after we saw some signs last month on November 10th, when that report was released. We got a really big surge in the markets because inflation finally showed that it was rolling over and starting to accelerate on its way down. Well, fast forward this Tuesday, we got another CPI report with data from the month of November showing again the CPI index has fallen further, now sitting at 7.1%. So coming down from about a peak, about 9.4% over the summer, down to 7.1%. And obviously this is good news. We're moving in the right direction. There's still a lot of work to be done. No one's happy with the CPI north of 7%, but I think the evidence is there that inflation is rolling over. It's turning into disinflation and will eventually, the narrative we believe in 2023 will not be about inflation. It will be about deflation. So naturally markets reacted favorably to this news. We saw a big move up on Tuesday morning. I'll show you the charts in a moment. But we had the Federal Reserve meeting looming on Wednesday, and that left a lot of investors just a little nervous. Really didn't want to chase the rally on Tuesday, even though that inflationary data looked really good, was a reason, to buy. A lot of folks were a little hesitant again in front of, I should say, the Fed meeting on Wednesday. So fast forward to Wednesday, we get that much anticipated Federal Reserve meeting, right? I mean, we're just constantly hearing from these Federal Reserve governors and the Fed president at this point. It's just overkill in our opinion, but nonetheless, part of their policy stance is talking or jawboning the markets. So that's what we've been dealing with for the better part of the last 2 years. So the Fed comes out Wednesday. They raise interest rates another 0.5%. Widely anticipated. Market was not surprised by it. To the highest level in 15 years. Now, it wasn't what they did that spooked the market, but rather what they said. So the money printing rock star himself, Jay Powell, took the podium at 2:30. Now, if you've been watching the Powell Fed as closely as we have for the last 5+ years, you know that markets hate when this guy gets behind a microphone, right? The evidence is there. The data backs it up. He's given, I don't know, something to the order of 24 press conferences with policy rate announcements in his tenure, and the market has sold off about 22 of 24 of those things. So the market does not like Jay Powell behind a microphone, and Jay Powell did his best to sound as hawkish and as bearish as he could possibly sound, basically saying, we're not done raising interest rates. We have a long way to go. We're going to raise them far above our projected forecasts. And folks, the bond market is calling total BS on this, and I'm going to show you the evidence for that in a second. So nonetheless, let's take a look at this week. Here's your S&P 500, right? Here is this move higher that we had on Tuesday morning, right? We jumped higher, good CPI, and then the market started to give the gains back, and it gave it another shot into Wednesday. We tried to rally again, and at this point right here, and I believe I can indicate this on my chart, this is where Jay Powell started speaking. Okay, so you can see the Powell effect on the markets. Lower, lower, and lower we go because markets don't like Jay Powell behind a microphone, and markets do not trust this Federal Reserve. Now, how do I know that markets don't trust this Federal Reserve? Well, if we know something about the Fed, right, we know there's a couple things. They don't ever lead with monetary policy, they follow. Now, who do they follow? They follow the bond market, okay? And when we look at the bond market dictates where Fed rates need to be. The Fed will never say this, but this is the facts as they have been for decades. Okay, the bond market, the debt markets are always smarter than everyone else in the room. They always know where rates are and where they need to be. And if they don't get what they want from the Fed, they will start to push on the Fed to do so. So the bond market was the first place when you go back a year and a half ago that started to sniff out the inflation, right? So when we look at the post-COVID era here, right, of us dropping rates because COVID was right about here, okay? The bond market yields, measured by the yield on the 10-year yield, if you want to keep track of this stuff at home, we talk about this all the time. When you look at the yield on the 10-year bond, right, that is the indicator for the market and for the Fed where rates need to go. So at a low point in 2020, the 10-year bond was yielding, let's call it 0.5%, right? Even lower than that, I think at its pure low, but was yielding about 0.5%. Okay, then the bond market started to sniff out the fact that we were going to have inflation. And what happened to bond yields, right? They started to rise. And they started to rise very quickly. Now, all this while, that bond yields went from basically 0.5% to somewhere north of 2.5%. The Fed ignored this and did absolutely nothing with interest rates, right? And then we get to this point with this vertical blue line here. And this is where the Fed decided that they would finally heed the advice of the bond market and start raising interest rates, right? That was March of last year. And since then, right, Fed was raising rates and the bond market was in agreement with the Fed saying, okay, yep, higher you go, higher we go, because inflation is still a problem. Well, folks, something very interesting, let me zoom in a little bit, has happened to the bond market over the last several months. Now, if you think back just the last two Fed meetings, and I know I'm getting into the weeds here, but I'm going to try to land this plane for you very simply. If you think about the last 2 months of Fed meetings alone, the meeting that occurred 2 days ago and the meeting that occurred about 40 days ago, okay? In November, the Fed raised rates by 75 basis points, and then 2 days ago, they raised rates by 50 basis points. So you basically had 125 basis points of interest rate hikes, 1.25% of fiscal tightening over the last 40 days. But yet, look what the 10-year yield on the 10-year bond has done over the last 2 months. This is topping out, folks. This is going lower. This is a very recognizable topping pattern, and we believe the 10-year yield is telling the Fed, you are too tight, your rates are too high, and it is time to stop immediately. Immediately. Not next week, not next month, not in June. It is time to stop immediately. Again, folks, I'm just relaying the message. I'm not the messenger, okay? This is what the bond market is telling the Fed. After an unabated run higher in yields, which was telling the Fed you need to get tighter and you need to move your rates higher, the bond market is rolling over. Particularly, all the while, right, we had 125 basis points of Fed tightening over this period, and what has the 10-year bond done? It's basically dropped by 100 basis points. So when you look at the spread between what the Fed's done, going up 150 or 125, and the bond market has gone down 100 basis points, there is a very wide gap right now between where the Fed is and where the bond market is telling them that they need to be. And the Fed can ignore this at their own peril, but they won't be able to ignore it forever, folks. These are the very same signs, identical signs that happened in the fourth quarter of 2018, December of 2018, right, when Powell decided to ruin Christmas and keep hiking rates when the bond market was already telling him they had gone too far. And shortly thereafter, I think about February of 2019, not only was the Fed not hiking rates anymore, they were cutting rates, folks. This time will be no different. Mark my words, the Fed will cut rates in 2023. It is not if, it is a when, okay? So when we back up now, why is the market having a crisis of confidence with this Fed chair, and with all the Fed governors? Because they don't believe what the Fed's saying, because the Fed has no credibility. This was the very same Fed that in the early stages of COVID said there will be no inflation, right? Not transitory, just there will be no inflation. Then inflation showed up, and they said, okay, some inflation, but it's going to be temporary, right? Transitory was their famous word that they uttered thousands and thousands of times through the course of late 20 and early 21, right? Inflation is going to be transitory. Fast forward 6 months, they wave the white flag on transitory inflation. They say inflation is entrenched, it's going higher, and we got a big problem on our hands if we don't get it under control. Okay? And now you fast forward to 2 days ago, and the Fed chair is saying, we're going much higher, we're going much harder, and we're going much further. And the market, the bond market, is calling total BS on that, folks. The bond market is calling total BS, and the bond market generally wins this battle time and time again, and we don't think this will be any different. Now, the other part about the Fed that really has us worked up is the Fed created the problem that we're in by printing way too much money, and now they want Americans to lose their jobs in order to fight inflation, okay? You can look it up, folks. Just this morning, Mary Daly of the Fed said we need to get the unemployment rate closer to 5% before our work is done on inflation, okay? So the unemployment rate, give or take 3.8, 4.1, depending on what BLS labor statistics you look at. So that's that Fed telling you we need to get unemployment somewhere between 0.5% and 1% higher, which every percent higher is 1 million Americans losing their jobs. Okay, so the Fed's saying, sorry folks, we created this inflationary nightmare for you by printing trillions of dollars out of thin air, but now we need some of you to lose your job in order for us to fix this problem. I think it's un-American, and I think that there's a lot of agreement on both sides of the aisle that this is a terrible approach from a very misguided Federal Reserve. So again, under the Powell Fed, we are in our third bear market in almost 5 years. Unprecedented. So if you feel like the market is wearing you out, you're not alone. Many investors feel that way. This has been a very difficult market environment. And as far as, recession, are we in a recession? We're not in a recession, right? It's our belief that the recession is here. Okay? You're not seeing it show up in every sector of the economy at once because right now, services are still, the service side of the economy is still doing very well because you have a lot of revenge spending post-COVID. But the good side of the economy is showing the pain. And when we look at some recent news from some very big companies, folks, in this marketplace, right? Just today, Goldman Sachs cutting 8% of its entire staff, okay, coming in January. Google, 10,000 employees, gone. Amazon, 20,000, gone. Right before the holiday season. Think about that for a second, folks. Okay, Meta, 11,000 people. We can go on and on and on. There's plenty of other companies and examples in corporate America where this is happening. Now, why am I telling you all this? Right, Mike, this sounds terrible. I'm not telling you this to scare any of you. These are the economic facts that we are faced with. And this, we believe, bolsters the case and proves the case that inflation has been totally vanquished and is on its way down. Inflation narrative will turn to deflation in 2023. The deflation narrative will have the Fed tripping over itself to cut rates quicker than they raise them on the way up. We've seen this movie before, folks. It plays out the same way every time. Timing is just the difficult piece, right? At what point does the Fed capitulate? Now, we don't hear from the Fed again until early February. I think it's February 1st is their next policy meeting. So between now and then, we'll get 2 more CPI reports. We'll get 2 more producer price index reports. We'll get 2 more labor reports. And I think by the time we get to that point, there's going to be ample evidence here that the Fed has significantly over-tightened rates in this economy, and they will be cutting rates in 2023. So I tell you all this to say this, okay? Markets bottom well before recessions end. Okay, markets clearly sniff out recessions before they happen, and they bottom before the recessions end. So if you look at some of the labor stats I just showed you, companies laying off, well, Mike, that sounds like the economy is about to crater. That's not what we're calling for. I think there's pockets of strength and pockets of weaknesses. This is kind of like a rolling recession, if you will, hitting different sectors one at a time. This is not 2008. Our housing market is much stronger than it was then. The debt held by mortgage, originators, if you will, is much more healthy today than it was back then. Credit scores are higher. Equity in homes is much higher. So this is not 2008, but nonetheless, the Fed is getting this wrong. They get it wrong every time. And eventually they will get to the right place. And when the market figures out, because it'll figure it out first, like I said about the bond market, it always knows before things actually happen on the ground. When the market figures out that the Fed is realizing this mistake and they're ready to turn this ship around, you're going to see this market fly. So our assessment for the markets here, we're in a very illiquid time of the year, right? This is late December. There's not a lot of institutions that are still moving big money around this time of the year. Most of the hedge funds are off in Aspen in their ski lodges for the holidays. So there's not a lot of liquidity in this market. That's why it's been gyrating like it has. Let me just bring up the S&P real quick and show you this, because we want you to have a full picture of the market. So basically, folks, let me just take this out of here. When you look at the market, right, we're doing a lot of movement with really no results, and that's not always the worst thing, okay? The October low is still holding firm. That's down at this level here. Let's throw that line up on the page, okay? We see we're still holding our October low. We've moved up nicely off that, and when we zoom in, after the November 10th CPI, we had this jump, and since then, basically, we've kind of just been bouncing in this area, and now we've round trip back to that point, right? So when you look at this, right, good CPI report, we ran up. Then Powell gave us a dovish speech on November 30th, not very long ago. We ran higher. Then we sold off that speech, and we tried to jump on a good CPI last week, and then Powell said, essentially, we're not stopping until you lose your job, right? I'm paraphrasing, obviously, and markets came back down. So as bad as this week feels, we really haven't done any technical damage to the overall picture. We're still holding above the October lows. We're still about halfway between the October lows and the August highs. So we're treading water in no man's land. And really, folks, if you go back and you look at this, right, I'm just going to drop another line on the chart, okay, you think of all this market has endured over the last 6 months, right? We're at the same place we were in May. So we've gone through an election. We went through nuclear bomb threats. We've gone through 2 earnings, reporting seasons where estimates came down, the numbers reported came down, analysts downgraded many of these stocks, and we went through the ringer basically over the last 6.5 months, and the market has digested this whole thing. We understand that these big gyrations don't feel very good, but if I had told you back in May, here's the litany of things that the market's going to deal with over the next 6.5 months, and you had to vote whether you thought the market was going higher or lower, most investors would have said lower. So again, choppiness doesn't feel good. Volatility wears on investors. That is the point of bear markets, folks. They give you hope, then they stomp that hope out. They're looking to crush souls and make investors despondent, right? That old feeling of, the heck with the market, I don't even care anymore, these stocks will never go up again, right? These are the types of things that investors feel near a bottoming process. And as far as a bottoming process, it's a process, folks. We don't know what particular day the market is going to bottom or if it has already bottomed, right? We could look back 6 months from now and say, yep, wow, October 13th, that was the bottom, right? Or we could have another retest of that low. Again, bottoms are things that you can identify when looking in the rear view. When you're going through it, all we can do is look for the signs and the fundamentals in the market that suggest that the data is telling us a move is about to happen. So again, in summary, the bond market is calling total BS on this Federal Reserve, and the Fed is not going to be able to ignore the bond market for very long. The dollar index is significantly rolling over, right? A strong dollar is bad for stocks. A weak dollar is good for stocks. So the dollar index is rolling over. The 10-year yield is rolling over. And when we look at the federal funds rate, and I'll bring that up and we'll end on that. The Fed funds rate, folks, is not going to stay higher for that much longer. Let me just zoom in here, right? Here's our Fed funds rate, right? We have moved up like a hockey stick, right? Parabolic with interest rates. So good luck to this Fed if they think there's going to be no side effects from that happening. But if you look, any time in the past that the Fed really got after it with raising interest rates, they raised, then they had to pause, eventually they cut. Raise, pause, cut. Raise, pause, cut, raise. I think we know what comes next. So we may not know exactly when it's coming, but we know what's coming. This is what we want to keep calm, invest on. You'll see we're slowly adding some things, quality names to the portfolio. The list of top flight, top quality American companies, great businesses that are down 50, 60%. The list is very long, folks. There will be tremendous opportunity coming out of this. We just got to get through it and make it to the other side. So if you have any questions, reach out to us. Always here to talk to you about anything that's on your mind. Hope you have a great day and a great weekend, and we'll see you back next week for the Heritage Market Update.